For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
We had a question from, I believe, a new member. Welcome, James. Very good question. Obviously, since change is new, all these things that you're asking about, which are excellent questions, we go over in every single session. But let me just kind of summarize what his question was, is basically, how do we know when it's a good time to enter a trade in either SPX or Russell outside of the rules-based guidelines, which typically are 56 or 30 days? And when do I know that the conditions are much better than average? Or another way to say that is, when do I know I've got a high probability setup and when I don't? And what strategy is the best to choose for the setup that I see? Yeah, and I've got one example, but I want to be a little bit thorough with the example, and then we could, because there's three different ways. This particular example is bullish. Is a bullish setup. So there's three different ways that I'm showing, and certainly nothing is that we show is ever exhaustive, the complete list of things, but this should give a pretty good idea, give us a good discussion. This is back on May the 3rd, 2024, Russell. This is a Russell chart. Obviously, I don't know. Everybody's got a little bit different technical analysis skills, but if you've been watching John for any amount of time on the market outlook, hopefully your skills are getting better. But what we have here is in the Russell, we had Russell's kind of chopping around over here, not really declaring itself. And then it breaks out and bounces this level, right? So now we can start to say, well, that's probably some sort of a pivot. Let's see how it acts when it returns there. Oh, it hit it and bounced. So that's a reactive area. Institutional players are active there. So instantly that becomes an area of interest and importance to us. Market comes back down to test it again. Rule of thumb is second or multiple tests of an area usually don't hold. Then we trade back below it. So, we're back sort of in this range. So one could claim, this range is now, we're below that. It's sort of out of play. Now we're playing back down in this lower range. But what we did is we came and revisited the bottom of this, right? We rejected, pulled back, and then we broke out of it. This is classic cup and handle pattern. And it's another concept we talk about, which is acceptance. When you break a support or resistance area or pivot, let's just call this a pivot, right? Because it's going both sides.
Yeah, I would call it a pivot area.
Yeah,
going up,
pivot.
down.
I mean, it depends on which side you're on. It's S or R, but it's a pivot for the conversation. And then you come back, you keep coming back to it. We tested it here, we tested it here, pull back, tested it here. The market is accepting the pivot. In other words, it's magnetic. It's more bullish in this context than bearish. If it were going to fail, it should have already done it. First test, it probably should have gone. Second test should have gone. Third test should have gone. It's not. So it's bullish. And, for those of us that are very adept with the cup and handle pattern, that's what it is. It's acceptance of a pivot. And that the market's rejecting and failing. Anyway, so we get the breakout. So I'm bullish, right? So this is a bullish setup. It's a very high probability setup for me because cup and handles have a high win rate. And how do I know that? Experience. You can go through the charts and find them on any time frame they work. Again, put your percentage on it. I'd say 75% of the time, but definitely more than half the time. And the way you had a comment, John?
Yeah. I was just going to say, probably, they're very strong pattern. I mean, 75%, I think, would be a good representation of that. Yeah.
Yeah. And if we use our fib tool, and just do 2 times the distance, or excuse me, add the distance, the difference in the high and the low of the cup pattern and add it to the high, we'll get
A target.
the target. So this is a high probability setup, meaning A plus, odds are very good that it's going to continue to go up, and the odds are very good that it's going to go to this target. Measured move of give or take 2100 in the Russell. Does that make sense so far?
It makes sense. Yes. Well,
Okay.
I'll let you know if we get a comment to the opposition, but right now.
Yeah. I didn't know if James got upgraded.
Okay. He said
panelist or
yes.
not.
He said yes.
Okay. Okay. So I'll move on. So let's talk about, okay, so we got a setup. What do we do now? Great. What strategy? What did he,
Right.
I mean, those are the right questions.
Mm-hmm.
So there's some parameters to consider, and before anybody says, "Oh, you're not considering everything under the sun," I don't have time to do that. Right? We're pros here. We know that the basics. I'm not
Right.
going to.
What are the important considerations?
Yeah, what's important for this discussion? So you need to think about the timing of your expectation. How quick, like for instance, when I say that, how quickly is it going to go get to my target? I can look at ATR. I can look at how long it takes for the market to go up the amount of points that it did previously. It's not taking that long. Let's see, what's that, 60, 70 points? It's pretty quick. You can look at ATR. You could just measure what has the market been doing previously and give you a good idea of how long that's going to take. So let's put a pin in that for a second. Then I need to think about, obviously, what is the market, the measured move? What's the destination of this move? Is it just going to, go to the moon? Is it going to go hit a target, turn around and come back, go sideways? We need to do a little bit of visualizations around our expectations of what the market's going to do when it gets to the target, to the destination. Obviously, we need to think about the time frame and fit that, right? So the way I'm going to show you three examples is I'm not going to just, let me see how I want to say this. I'm not going through this list and confining myself to an answer. I'm considering all these things, right? So I could come in here and say, it's going to go to, the Russell's going to go to 2100 in 10 days. So I'm going to put on a 14-day trade. And the best way I think I want to take advantage of that is a vertical. You could do that. But I think a more robust way to do it is to think about what strategy you want to use and fit it with what you visualize the trade's going to do. I don't know if that made sense or not, but we've got this setup. You've got a cup. You got the handle. We expect the market to go up to the 2100, but what's it going to do after that? Right? Is it going to come out here and flag out and go higher? Is it going to come back down and test the breakout point? Markets love to do that. Is it going to play somewhere in between? Then that's going to help me pick a structure. Then I'll start thinking about time frame. When I say time frame, for this, we're talking about DTE. Which expiration do I pick? So that's I feel like a little more robust way of doing it. It's not the only way of doing it. And then you need to decide, how much are you willing to risk? And these examples, we're going to say $2,500. And you have to say, I probably should have put this in here. Where am I out? Depending on what trade is I've got on. So a couple of these, I'm going to have a technical exit. And I'm going to say the technical exit is if we fill this gap that was created by this day and close back under this pivot, I'm out. Now, let's just call it 2,000. It's probably a little bit conservative, but let's just say 2,000. If the market closes back below the pivot, which is, for our modeling purposes, we're going to use Russell 2000. And then
James is asking if you look at the number of days between highs.
The number of days between highs. Yeah, I mean, that's kind of your cycle. Your cycle run, right? You could say
I actually look at the cycle run, but I also look at the slope of the run. So I basically will assume the same slope. And
yeah. So you could say that is a leg, right? And you could say, what's the rate of increase there? That's a leg. So you could do that. Yeah. I mean, if you really want to be precise with it, that's what you would do to try to gauge speed, depending on what you want to accomplish. So to kind of clean up what I was saying before, if you think you're just going to go here to the target and you want to be done, maybe you do a 7-day trade or 10-day trade. Maybe you could even probably do shorter, and you just hit the target and you're done.
The slope's not saying that's probable though. Like if you take a look at the slope of what's going on there and the slope that's in the past, it's probably not going to do that.
Yeah.
Right. It's probably going to be later.
Yeah. So if you do think it's going to happen in the short term, that should inform you as to what structure you want to be in. Don't want to be in, a neutral butterfly at the money 40 days out. You're not going to make any money, right? Market's here, your butterfly's here. So that's kind of an extreme example, but you might be in calls if you think it's going to go up that quickly, or verticals. I wouldn't want to be in a M34U short dated. I'm talking about, let's assume what I'm discussing right now is like 7 to 10 days out. That would not be, because in a BWB short dated, it's only going to make whatever's here, and that's probably going to be flat or maybe a little bit of a credit. I want to make money here. I want to make money here. I want to make money here if that's a call, right? So you think about visualizing. That's kind of what I'm trying to drive home there, of what this move is going to look like. How does it get there? That's the phrase I've been trying to get to. How is the market going to get to the 2100? And then what's it going to do afterwards? And can I capture both sides? We'll see. So the possible strategies, again, is not exhaustive. You could do an M34U, you could do a Super Bull, you could do some calls, you could do the 63 Bull, which is the Hammett trade. So it's a more aggressive BWB where you enter with the market at the back of the BWB, for those that aren't familiar.